small cap growth environment has been choppy over the last 12 to 15 months. This has been the relatively rare example where investment strategists entering 2014 thought that small cap stocks might lag larger stocks, and indeed that has been the case, unlike so many other financial markets where, for instance, forecasts of interest rates or prognostications on energy prices have proved difficult or wrong. So small cap stocks have lagged big cap stocks, which is actually not that surprising because in the 5 prior years, coming off the market bottom in 2009, small cap stocks have returned about 25% a year. So they had a very, very strong 4 or 5 year run compared to larger stocks, and 2014 has been a period where the larger stocks have been playing catch up to smaller stocks. Earnings have been coming through pretty well in the small cap environment this year. We think earnings next year could be up in double digits again, and we think that while multiples are at a slight premium to long-term averages, we think they're very attractive compared to alternative investments. I certainly think the overall economic environment, while we don't manage our strategy with any kind of a macro view, but I certainly think my partners and I believe the overall economic environment is supportive of continuing appreciation in small cap growth stocks. Our labor markets are healing nicely. Government finances, both at the state level and the federal level, are immeasurably better than 5 years ago. Capacity utilization in the industrial sector has improved considerably to the point where capital spending should kick in. And most recently, energy prices declining should be beneficial to consumer spending. So for a variety of reasons, our economy, the U.S. economy, looks to be quite supportive to higher equity prices in 2015. Combine that with the last 12 to 18 months where small cap stocks have had declining PE multiples compared to their earnings growth, we think that presents a pretty compelling risk reward for the small cap growth space. We manage the portfolio as bottom-up stock pickers, so our industry allocations and sector allocations with risk controls that we put into place in this strategy are driven by where we find attractive companies at the right price. That said, we've been overweight information technology for much of the last 7 or 8 years. We find that there are a number of very compelling information technology companies bringing solutions to the marketplace to enterprises and governments. So for instance, the security side. We've all been reading about the numerous hacking episodes in 2014. We have a number of companies that are providing security solutions both to enterprise customers as well as small and mid-sized customers that are trying to outrun the hackers and the bad guys and prevent all of our client data from being stolen. One of the areas where we've been relatively underweight over much of the last 5 or 6 years is in the healthcare side. We think early-stage biotech companies present more risk than reward. And we've seen that in numerous examples where companies will declare phase 2 test results and there'll be very sharp sell-offs in their stock. So as an alternative, my partners and I have been investing in the companies that we think of as the picks and shovels for scientific discovery that are helping companies discover those compounds, companies that are either in analytics or in contract research services to the biopharmaceutical industry. And that way we participate in the growth and development of these early stage compounds without taking specific compound risk. The best way that we can reduce risk from the portfolio is doing a thorough analysis of the companies in which we invest in our strategy. Having said that, we're not unmindful of several risks from the macroeconomy, and the 2 biggest ones that my partners and I are keeping an eye on are the decline of commodity prices and the collateral ripple effects that may affect companies in the U.S. economy, and secondly, a potential rise of interest rates now that our central bank, the Federal Reserve, has ended its quantitative easing program substantially. We're very mindful about the decline of energy prices. This has been a very sharp decline, a very sharp shock, and there are doubtless going to be companies that are affected, especially in the energy patch, and capital goods suppliers to energy service providers. On the interest rate side, our companies are extremely well capitalized, so indeed it may benefit the companies that we own in the strategy as companies that are more debt encumbered begin to suffer from rising interest rates.